165 million will get you a proper house in some of Kenya's high-end estates like Muthaiga and Runda. And shortly, I'll tell you how you can do just that. For now, listen very carefully to what I'm about to say, because it involves a single mistake that thousands of Kenya businesses make, and they do this without realizing it. And when this happened, it cost one of Kenya's most successful companies, and it cost them dearly. When you borrow money from a bank and pay interest on that loan, you can usually deduct that interest from your taxable income. This is standard and it's available in the Kenyan law. But here's what most people do not know. You can only deduct the interest if the money that you borrowed was being wholly and exclusively used for your own business. The moment that you borrow money and that money leaves your business to help someone else, even if it's a related company, even if it's a sister company, or even another company that is run by your own family, the interest that you pay on that money is no longer allowed as a deduction for your income. And if you don't agree and you go ahead and deduct it anyway, KRA will find it. And when they do, I don't need to tell you what they are going to do. Because Tile and Carpet Center found out, and they found out not in the best of way. Now, Tile and Carpet Center has been in operation since 1946. They are one of Kenya's largest hardware and home improvement retailers, not just in Kenya, but in East Africa. They have hundreds of employees, and they have their own flagship showroom on Mombasa Road. In 2010, as we were getting ready to use the new constitution, the company made what looks like a simple decision. They went to the bank, borrowed 165 million, gave that money to a lawyer to go and buy a piece of land. Now, that land deal fell through. And when the land deal fell through, the money came back from the lawyer. Yeah, you may not believe it, but there are lawyers who give money back when the deals don't go through. I was surprised. So, to Tile and Carpet Center, there was no deal that was done, there was no harm done, or so they thought. But the tax question that came back with that money was one question that they were not prepared for. And when they tried to argue it out in court, they discovered that one piece of evidence that would have saved them was the only piece of evidence that they could not produce. By the end of this video, you will understand exactly how KRA traces borrowed money through your accounts. You will also understand why retained earnings, which is a figure on the balance sheet, are not the same as cash in the bank. And I will also tell you the document that you must absolutely keep if you ever plan to argue that borrowed money is the same as your own money. In July and October of 2010, Tile and Carpet Center Limited did something that seemed very straightforward at the time. They went to the bank, transferred 165 million to a lawyer. All they wanted was to buy a very attractive piece of land. And for you who don't know, I sell land too, so if you have millions, give me a call. Back to our story. But here's two unusual things about the transaction. First, they were not buying the land for themselves. They were buying this piece of land for a sister company called Tile and Carpet Development Limited. Secondly, the money came from the company's overdraft account at I&M Bank. Now, for you who do not know, an overdraft is borrowed money. Not your own money, but borrowed money. An overdraft is the money you draw when you need it and you pay it back to the bank with interest. It's something like Fuliza, but for bigger companies. Sadly for the lawyer, this deal collapsed. Even though the lawyer had imagined earning commissions, it didn't happen. The seller changed their mind. That's why by March 2011, the lawyer returned all the 165 million to Tile and Carpet Center. At 3% commission, let me see how much the lawyer would have made. So 3% of 3%. Anyway, that's not very important. What's important is that the money went right back to the same overdraft account it had come from. If you look at that transaction, on the surface, everything looks very fine. No land was purchased, no harm was done. And the money went out and the money returned to where it had come from. But the Commissioner of Domestic Taxes, who is KRA, was not looking at the surface. He was looking at the interest that had been charged on the overdraft facility. Remember, this money was withdrawn from an overdraft account. For that year, Tile and Carpet had borrowed a total of 770 million from the bank. The interest on that total borrowing was around 84.8 million. Now, Tile and Carpet wanted to deduct the entire 84.8 million from their income before calculating the actual tax that they owe KRA. And the commissioner looked at that and said, wait a minute. The commissioner did the arithmetic and did the arithmetic carefully. Now, KRA noted that for several months in the year 2010 and part of 2021, the 165 million of whatever Tile and Carpet had borrowed had not been sitting with Tile and Carpet at all. That money was not being used in either buying or manufacturing of tiles. That money was not even being used to pay employees. It wasn't even being used to pay utilities like rent or repairs. That money was sitting in a lawyer's bank account waiting to buy a piece of land for a different company. So the money was just in the lawyer's account, keeping it warm. In fact, and that's not good according to KRA. If you keep money there, then you should be responsible for paying the interest on it. KRA did the arithmetic. The interest on that 165 million during all those months that the money was with the lawyer was 2.94 million. So, correctly, the commissioner told Tile and Carpet that interest that you have charged is not a deductible expense at all for your business, and you need to pay tax on it. And once KRA did that, the real battle began. Tile and Carpet was very unhappy with this decision. From their eyes, they argued that they had not actually used the overdraft facility from the bank at all. They claimed that the 165 million that they had sent to the lawyer came from their own retained earnings. Retained earnings, again, are profits that have accumulated over the years and are sitting within the business. Like you make a profit, you do not withdraw it. So according to Tile and Carpet, that's the money that they are using to buy the land. They also claimed they are a large company, they are a financially strong company, and they already could show in their balance sheet that they have enough retained earnings to buy the land for 165 million without needing the loan from the bank. Now, this argument went to the Tax Appeal Tribunal, and it also found its way to the High Court before Justice Ajanja. And this is where the story takes a turn that I think every business owner needs to hear this and hear this carefully. The commissioner's lawyer did not argue around financial statement or those retained earnings. She picked something that was much simpler. She picked up a bank statement. Then she pointed out to the account number on the check that Tile and Carpet had used to send that money to the lawyer. Then she pointed to the same account number when the lawyer sent the money back. She said slowly and clearly, look at what the bank calls this account. The bank calls this account an overdraft account. This is not a savings account. It's an overdraft account. She then made the argument that changed everything. That retained earnings, according to her, are just a number on a paper. That retained earnings are just an accounting entry in your books. You cannot pay a lawyer, or you cannot even pay an accountant, or you cannot buy anything using retained earnings. All you can use when making payment is cash. Well, or a check, but let's say cash. Now, the cash that went to the lawyer came, remember, from the overdraft account. It didn't come from a savings account. Now, the cash that came back from the lawyer went back to the same overdraft account. And this means simply that the money that went from an overdraft account, the money that came back came to an overdraft account, which means this was borrowed money. Now, for a full 9 months that Monday was pregnant for, all those 9 months, the borrowed money was not working for Tile and Carpet. It was helping a different company. Now, Monday's story is not important. It's not even related to the case, so let's move on. KRA said that the interest on the loan for the whole period that Monday was pregnant was not a business cost for Tile and Carpet. Now, Justice Bajanja considered the evidence that has been presented carefully. He looked at the bank statement. He looked for bank statements or other records that would show that Tile and Carpet Center had either substantial cash reserves that would separate it from the overdraft that they had received. Now, this is the kind of evidence that would support the claim that the 165 million came from retained earnings and not borrowing. After looking, he found none. Then he wrote a line in his judgment that has since become very famous in tax circles. And he said, nothing would have been easier to provide than a statement of account that shows that Tile and Carpet were sitting on a substantial cash reserve. Tile and Carpet had not provided that statement because they simply could not. And because of this, Tile and Carpet's appeal was dismissed. And when the appeal was dismissed, the tax was confirmed. This case carries a lesson that goes well beyond Tile and Carpet. If your business has an overdraft facility and you're drawing from that overdraft facility, you are being charged interest. You need to be able to show that the money that you are borrowing is being used for your own business during that period. If any portion of those funds left to your business, maybe you took an overdraft and you used that overdraft to support a company that is related to you, or you took an overdraft and funded a personal transaction, or you took the money and it sits in an agent's account waiting for a deal to come through. The interest that is attributable to those funds is not deductible for that period. Now, the second lesson is around the difference between accounting entries and cash. For your business, retained earnings appear on your balance sheet as a positive figure, but retained earnings are not necessarily cash. Retained earnings represented accumulated profit that may have already been invested in other items like land or equipment or inventory or receivables. If you want to argue that payment came from your own cash rather than from borrowings, you need to prove that simply by providing a bank statement. And this bank statement should be showing that cash was actually sitting in that account by the time that payment was made. A balance sheet entry is not enough to prove that. The court will not accept it, and neither will KRA. Here's what you need to do. If your business has related company transactions, or you're having like intercompany loans, or you have shared facilities with like sister companies, and you're claiming interest deductions on borrowed funds, this case should prompt you to review the positions that you are in. But don't worry, you can reach out to us and we can help you understand where you stand and what documentation you need to prove and protect the deductions that you may be making. In the next video, I'm going to tell you about a construction company whose director is in Nairobi. And this director won a tender, they supplied, they got paid, but instead of paying KRA, they decided to make the company disappear. And they did this by striking it off the company register while it is still owed KRA over 262 million. He succeeded. The company vanished from the register of companies. And then the court brought it back from the dead. And once it came back, the director lost. Watch this video because it's one of the most dramatic stories you will get on this channel.